As we all know, there's three types of market environments. We have our bull markets, our bear markets, and a sideways market. Well, this module is all about really teaching you so that you can learn 7 of the top option trading strategies used to profit in a bull market. You're going to learn things like, how to buy long call options, sell a naked put option, buying a vertical call spread, selling a vertical put spread, buying an out of the money call calendar spread, and also buying a diagonal spread. And I'm also going to throw in some advanced bullish leaps trading strategies on how you can kind of finance your leaps positions with some of those embedded strategies we just talked about there. So to finish off this section, we're going to really explain and make sure you understand how to properly choose the right bullish strategy to really fit with your risk profile and your tolerance, and make sure that it's suitable for you with your trading objectives. So this is where all the fun begins, because now we get to talk about some live trades and how you can make money with this in a bull market. So I'll see you in the first part. When you buy a call option, this means you're long the stock. So this is the most basic option trade available when you're in a bull market and you want to trade options. So this is known as a level 2 options trade, and it's the same as when you buy stock. You buy to open and you sell to close. You want to buy at the ask price and sell to bid, but more so than that, now that you're getting more sophisticated, you actually want to buy at the mid price between the bid asks. That's going to be the theoretical price, and that's going to give you the most fair and accurate value for the cost of the contract. You need to be very careful, because options, when you buy them, you're fighting the clock. They're decaying assets. When you buy a call option, you need to give yourself time. You want to see that the stock is in an uptrend and the overall market is in an uptrend, and you need to give yourself at least that 3-month time cushion. You want to see a large volume spike to the upside. The stochastics or whatever oscillator you're using, you want to see that oversold or moving higher with a phantom indicator. And you can have an option contract that costs less money out of your pocket to put on and have the ability to make more of a return than buying the stock, then that should be something that resonates with you and piques your interest, because that's what this is all about, is to show you what is possible for you as a self-directed trader or investor to increase your overall returns in the market. There's all these different factors, these technical factors that really influence and help confirm this bullish breakout. So you can see that we have a substantial volume spike, number one, with a gap up, and this is very bullish. So that created a huge surge in demand. The supply wasn't there, crossed with powerful MACD and stochastics rising, and things are looking good. There's no resistance in sight. It broke out, had a strong momentum moving forward, so I bought a call option. It's really important that you understand how to read these types of P&L graphs, but more so than that, just know that when you buy a call option, it has a rising equity curve to the upside as it moves in your favor. There's a break-even point that you have to understand, plus the costs or the debit of the underlying contracts. That's also going to be your max loss, and understand how things are going to work for you as you move forward. Going long a vertical call spread. And this is basically done by you purchase a call and then you sell a further out of the money call in the same month, and this is done simultaneously. So it's a packaged trade and it makes for a debit spread. The purpose of the trade is to get long deltas while minimizing the natural time decay that is found when purchasing short-term options. They're made up of positive delta, positive gamma, flat theta, and positive vega. This is a simple level 3 options trade, and the width of the spread is the maximum profit zone. This is a debit spread trade that you pay for up front. The debit is the most you can lose, and the goal of the whole entire trade of buying a bull call spread is for the stock to move up through the sold strike price as fast as possible. I have the GLD up right here and just kind of showing you what the trend looks like. So we have a high of 129, a low of 109, a very strong support at 109. However, if we zoom in and look at a little more streamlined perspective, and you can see we're kind of in a sideways trend, but slightly making higher lows. We have a low in here, very strong horizontal support level at 109, 110, and then we have a low in here with kind of a morning star formation, and it looks like it's moving higher. So I would say that if I was going to get bullish, this would not be a bad underlying security to get bullish on and put on a vertical call spread. Selling a vertical put spread, and this strategy is also known as a bull put spread or selling a bull put. This strategy, not only are you selling a put, but you're buying a further out of the money put in the same month simultaneously, and this makes for a credit spread, but more so than that, a defined risk spread trade. And this is a simple level 3 trade that you can do with option privileges in your account. And the purpose of this trade is to get bullish or long delta while being able to generate income with that positive theta from the positive time decay in options. That's the benefit of being a net premium option setter. seller, and that's what comes with credit spreads. What I'm looking to do is I'm looking to sell a put spread right under this moving average. The sooner the expiration, the less credit you're going to receive. Of course, you can see your extrinsic value. The most value is going to always be at the money options. You're more sophisticated, you're a smart trader, you know how to take off a position for a loss if needed, and you understand how the relationship of margin requirement, which is perfectly normal when you're trading options or credit spreads, that's part of the game. You can always modify your Greeks and take off your positions well before expiration, and that's what you're going to do a lot of the time. The first strategy that you learned in this module was buying a call option. The second strategy you learned is selling a naked put option. Now, the third bullish trading strategy that you learned was buying a vertical call spread. The fourth bullish trading strategy is to sell a vertical put spread. The fifth bullish trading strategy you learned was to buy a call counter spread. The next bullish trading strategy you learned was to buy a call diagonal spread. The last and final bullish option trading strategy that you learned was to buy a leaps call option. I recommend you practice this, test it, implement paper trade, and become familiar with these different strategies. Whichever ones work best with you, focus on them, develop your strengths, and continue the process.